Well, probably it will remain more or less the same for the next 12 to 18 months. Then after, it's more difficult to say. Personally, I have more and more difficulties to be convinced on some of the yields I see on the market currently. I believe these values might not be sustainable over a long-term journey. So personally, I like take care about that, and that's why I prefer going for developments. Because I think today the best part of the market is supply and demand dynamics. So I prefer to take the leasing risk, entering into acquisition at softer yields and trying to create value. And I think I prefer to choose this risk rather than buying at the price of today, what is very core, very prime. I don't think it's for us.
And do you see yields continuing to drop?
Well, at one point, there is a limit. When you reach 5.0% NIY in Germany, I think you're reaching a limit. So all the countries are not there. All the countries are able to reach this 5.0. I don't believe so, because when you reach that kind of yield, you need complete scarcity of land around, top building, top tenant, and so all the market is not like this. But probably there is still some room for yield compression in France, still in Central Europe, in Southern Europe. In Germany, I don't know. I don't think so.
Okay, good. Does anybody else have a view on that yield issue particularly?
And I think it looks at where else you put your money. And that's one of the problems with debt so low. Actually, I think in the UK, they're already down at 4.5 and probably going to drop, there's going to be more compression. And I think if the UK drops to 4%, I think Germany will follow sub 5. I'm not saying whether it's right, but I think prime on a long lease, if you had an Amazon now, well, your favorite, Kevin, but if you had an Amazon on a 10, 15-year lease in Germany now, I think in a top city, one of the top 5, I think you'd probably attract 4.5. And I think, but I would say it's new territory for us all, and it's getting ahead. But then if you've got governments able to sell bonds at negative interest rates. I remember the first time in Switzerland, I think it was a year ago, they had 350 million at -0.5%, and it was oversubscribed. And you think, hang on, so I give them my money, and I'm guaranteed in 3 or 5 years' time to get less back. But compared to what they think they can do with the rest of their money, that's actually could be a good investment. If it becomes -1%, then actually maybe that's a good deal. But it's a bit, the bond market's a bit beyond me.
Christoph, yeah.
Yeah, I think if you compare the banking market, the German banking market, to like the UK banking market, or even in the French market, then you see that the margins in Germany are significantly lower than in other European countries. And we did the exercise to see, well, could we maybe invest in Spain? We saw it's a good market, maybe seen some rental growth, and then we compared on a like-for-like comparison, and the returns then on a IRR basis, or even on a cash-on-cash basis, are better in Germany than they're in Spain and in France. So our investors were saying, well, why should we then go into those countries when in Germany we still find value? And I think nobody of us expected that the euro interest rate go to naught. I mean, that was a complete surprise to all of us, I think. So I think we're going to see some more yield compression in Germany. So we're not there yet.